Hello and good morning, everybody. Welcome to the second seminar from Golden Pie. I'm Abhijit, and today I'll be talking about why is it a great option to invest into bonds? What are the couple of things that we should be careful about when we are investing there? Basically, the do's and don'ts, and we'll see a few examples on the way. Now, during this webinar, I will be hosting a couple of polls and see the reaction from all of us over here, participants. Now, during the course of this discussion, whenever you have got question, please feel free to type in your questions in the Q&A block in your, in your Zoom panel. At the end of this webinar, I'll take up the questions and answer them to the best of my abilities. I hope that by the end of this discussion, I would have been able to share something valuable with you, which will help you in taking a small step ahead in your successful investment journey. So let's start with a poll. Here's the question. How many of us are concerned about the rising repo rate in India? The choices are three. Yes, maybe, don't care. All right. And here are the results. A majority of us in today's discussion today have expressed concern over repo rate. A lot have said that maybe, they're not very sure what stance to take, whether to be worried, concerned about it. And a few percentages have said that, they don't consider it at all, right? Now, I'm sure, this brings us to a very pertinent point that we would have been bombarded with a lot of information from the media about the rising inflation rates, then RBI stepping in again and again and doing repo rate revisions. And we must be wondering, like it's very evident from the poll over here, what is it that's going on between these two factors, inflation, repo rate, and then largely, do they have an impact on our investment into fixed income, specifically bonds and debentures? Let's try and understand. So the first question is, what is inflation? Simplistically put, inflation is the measure of how much expensive the goods and services that we are availing in a day-to-day life have become. Currently, the inflation rate in India stands at 7.01%, and which means that the commodities that we were purchasing some time back at, let's say, 100, today they would be costing approximately 107 rupees, which means they have become more expensive, and which also means that more number of people are finding it difficult to avail these facilities, to avail these commodities, to buy them, right, for their consumption. Then what is it that is being done to control this? One of the fundamental levers in economy that is used by the central banks across the world, and which is Reserve Bank of India for our country, is controlling this inflation through repo rate. So then the question is, what is a repo rate? This is the rate of interest at which the central bank lends money to the various commercial banks in the country, and then the banks in turn lend it at a higher interest rate to various individuals, or non-individuals across the country. It can be you and me, people who are taking loans, or it can be, corporates and other institutions. So what the Reserve Bank of India does is it actually increases the repo rate, and by which what happens is the amount of money that is available excess in the economy gets sucked out, which actually brings down the inflation. Now, there are deeper, explanations to it, more detailed. We won't get into that. What we need to understand is repo rate is used by the central bank as one of the key measures to bring down inflation. Now, I'll draw your attention to the graph, which is there on the right-hand side. The blue line is basically the inflation, and the red line represents the repo rate revisions that have been done. So between 2017 to 2018, when the Reserve Bank of India increased the repo rate to 6.25%, subsequently, in the next year, the inflation reduced to 3.72%. The following year, When the Reserve Bank cut down the repo rate to 5.40%, the inflation sprang up to 6.62%. So in simple words, repo rate and inflation are reversely related. Now then a lot of us must be wondering, then with all this, how is it related to bond investment? Well, my dear friends, there's a very deep and direct correlation between repo rate and bond returns, or yields as we call them. So the relation is, when repo rate rises, the bond returns in the market also rises, which essentially means that every time in the past, the Reserve Bank of India revised the repo rate and increased it by a couple of basis points, the yields or the returns that we can make from bonds have increased. Rather, so for any first-time investor, that would have been a very sweet spot to make investment, because they would have got the yields at a higher level than prior to the revision. Now, with this understanding, let's now step in to the central theme of today's discussion, and that is, why is it an intelligent choice to start investing in bonds as a fixed income option? There are four primary reasons to this. First one, we need to earn returns on our investments which will surpass at least the inflation level. I'll draw your attention to the red line in the graph over here. 7.01% is the inflation rate. The standard FD rates, which has been the dominant investment option across India, right, stands at around 5.5%. But when you look at the entire spectrum of bonds and debentures as fixed incomes available in the market, starting from government securities, which are highly safe, and they are the ones issued by the central government via the Reserve Bank of India. As of date, the 10-year government securities, or GSECs as they're popularly called, right, yields a percentage of 7.4. Now, as you go down, the rating chart from AAA to A, you can get anywhere between 8% to 12% based upon the instrument that you're choosing to invest. Second, bonds are a very good and efficient way to generate regular cash flow and generate that extra income which will hit your bank account periodically. Let's look at a quick example of one sample bond, UP Power Corporation. The minimum investment in this stands at 10,07,000, right? Representative figure. It pays on a quarterly basis, which is shown in the cash flow on the right hand side. For every unit of bond that I would have purchased, I would be getting a quarterly interest of around 25,000 rupees, and that is something which will be hitting my bank account. So this is a series of cash flow which gets added to my existing income. Third, bonds can be used very effectively to time expenditures on specific life goals. Now let's understand an example, a very common one. A family is saving up money and looking to invest now, so that 5 years down the line, when their kid is in the position to join college, they're able to fund his or her education and college expenses and all that effectively. So what can they do while using bonds? They can consider a bond which has a precise tenure of 5 outstanding years. So today, if just as an example, they put in the funds of around 10 lakhs into this bond at 10.15% coupon, the bond is going to generate cash flow, which will be deposited into their bank account. And by the 55th year, when the bond matures, a total lump sum of 15 lakh will be there in the bank account, which then they can utilize for the kids' college expenses. So as you can see, this is a very efficient way of investing and timing your investment to meet life goals. And last but not the least, diversification. This is the golden rule to actually have your portfolio smiling all the time, no matter whether it's a rainy day or a sunny day. And what's the reason? Let's try to analyze this with respect to two persona of investors. The first persona is that of an aggressive investor. So how does his portfolio look like? This is a sample representation. So portfolio one is his, shows his composition of his investments, wherein 50% is into equity, 30% is into, let's say, equity mutual funds, and 20% into real estate. Now I'll draw your attention to the right-hand side, wherein there is a graph of the returns that his portfolio is making, right? Portfolio one, which is represented by the blue line, is the one that you can see, has got a tremendous dip in year 2020 when the markets actually crashed down badly, right? And then this sprang up. Vis-a-vis this, if this gentleman would have diversified his portfolio by including bonds in them, which is represented by portfolio two, let's say now his composition stands at equity of 50%, real estate of 20%, and bonds of 30%. In the worst year of 2020, you see, which is represented by the red line for his portfolio two, it still stands at positive, right? So the key takeaway here is, if you include bonds into your portfolio, it's going to give you a positive cushion during those times wherein your portfolio can crash down, and equity heavy portfolio can crash down, right? On the other hand, if we consider the portfolio of a conservative investor, this is a person who has got his investments tremendously skewed towards fixed deposits, bank fixed deposits, wherein the share of this is 80%. He holds gold 10% and equity of 10%. That portfolio is shown, the returns are shown for the past 5 years in the blue line. If he would have included bonds into his portfolio, then the math around the returns that works out with allocation as 20% in FD, 10% in gold, and 70% in bonds. This is clearly represented by the orange line. And the key understanding that we should take from here is that with this diversification, he has actually got greater returns on his portfolio than otherwise he would have just kept his money into FD, gold, and a little exposure into equity. So in a nutshell, what I meant to say is that with diversification for aggressive investors, with inclusion of bond in portfolio, bonds provide a very efficient cushion during the bad days when the portfolio can crash down or the equity component can crash down. The bonds with the fixed returns will give a very good cushion over there. And for conservative investors, if they include bonds beyond FD and gold, the overall return on their portfolio is going to be much higher. Now, let's look at another question. Here is the question before you. What kind of an investor are you? With which of these persons are you able to associate yourself with? And the options are three. Are you an aggressive investor wherein 80% of your holdings are into equity? Are you a balanced investor wherein you have a fair division of your wealth investments across risky assets of equity and fixed income assets, 50-50 sharing? Or are you a conservative investor wherein you have put 80% of your investment or more into the traditional investment options like bank FD, PPF, NSC, etc.? All right, I'm going to close the poll now and share the results. So 27% of us have said that we are aggressive investors. 52% of us have said that we have a balanced portfolio, which is great. And around 20% of us have mentioned that we are on the conservative side. Now, the next thing that we are going to discuss are the various things that we should be careful about, we should keep in mind, some basic sanity checks that we should do before we invest into bonds. Basically, the pitfalls and mistakes that we should avoid. First one, we should not be chasing yield or returns from fixed income investments. That is, we should not be greedy, right? If you look across the entire spectrum of fixed income options in bonds, right? They start from GSEC, which is the safest option. And then you can go down the credit rating from AAA, AA, A, then triple B, double B, B, C, and then D, which is default, right? Now, of this entire pack, from government securities, GSEC, which are termed as sovereign guaranteed, till triple B, this set of bonds are termed as investment grade bonds. And this is a classification that is put forward by the government of India. And the bonds which are below this rating, which is double B onwards, are considered as junk grade bonds. Now, if you pick up a junk grade bond, you would be getting anywhere between 20% and above, right? You should understand that there's a high level of risk which is involved over there, because of which they are called junk. So it becomes important to look at not just the yield, but also like, what is this company that I'm investing into, right? Is it run its business well? Are the financials okay? Having a holistic outlook over there, and then invest. Second, we should not get attached to any specific bond issuing company. And the reason why I say this is because, in today's world, we are continuously bombarded with ads, news across multiple media, and brands get established in our minds in that way. So when we have the requirement to choose something, our mind takes a shortcut of, using what is there at the top of the mind, the brand. And then we go ahead and, do it because we have been seeing so much amount of news and ads and information about something, right? This is a big caveat for investors. There have been examples of defaults in the past, like ILFS, Yes Bank, DHFL. They have been very big brands, very powerful ones, and yet there were incidents of default wherein the investors lost their money. So it is very important that we just don't go after a brand, but actually look beneath it to do more due diligence and then choose the bond. Basically, we have to be rational around what to pick up for investment. Third, many a times, first-time investors into bonds, in pursuit of trying to take a quick hack of finding the safety of a bond, they just use credit rating as the quick hack to actually understand what is a safe bond versus what is the risk level in a bond that might be based upon the credit rating. This is definitely something which we should not be restricting ourselves to while evaluating. We have to look way beyond credit rating. Why? Because the credit rating agencies, they try to do a fair work, but then they get a limited amount of information, and often the information might not be up to date with what the company is actually doing. Then what should we actually be doing? At least we should look at how has the company been performing in the past 5 years. Just look at the financials. Have the revenue been increasing for the past 5 years? Is the profitability margins increasing for the past 5 years, or have they gone down, right? How is the management quality? You'll get news, right? In internet, most of the information is available. Are there any bad news, good news about the company? Consider all that and then shortlist your bonds. And last but not least, even in bonds, it is important to follow the philosophy of diversification. Now, I might, like bank bonds because I feel they're very safe and I'll consider them only. But the best approach over here is actually to pick up bonds across industry categories. And by doing that, what happens is not only am I diversifying and hence building a resilient portfolio, which is safe in case some extreme scenario happens, but also by diversifying, I'm able to actually capture across the yield curve, ranging from low yield, very safe, to high yield on the riskier side, and so get a very good blended returns on my portfolio. So few examples of issuers: state government guaranteed bonds, public sector bonds from public sector units like NHAI, REC, RFC, or public sector banks like State Bank of India, Bank of Baroda, so on and so forth. Private sector banks, corporates, and NBFCs. These are a couple of issuer types which are popular ones from which bonds and debentures are available. Of course, there are several other such categories, and based upon your requirement, you can look them up. Now that we are aware of what to be careful of, the next natural question that comes to the mind is, okay, I have this information and I know in the market probably there's a long set of bonds, a large set of bonds. In fact, 20,000 outstanding bonds available, for investment in the country across the entire spectrum of credit rating. From this humongous number of bonds, how do I shortlist to the ones which will suit my requirement, my persona, right? My life goals. So for this, we can use actually a model called as a part model. Now, this is not something which is written in stone that has to be used. It's kind of a heuristic model, a quick method which will enable us to shortlist bonds of our choice and be yet diligent on what we are doing during the shortlisting. So let's understand, how does this part method work? The P in part stands for purpose. A stands for amount, R stands for risk, and T is for tenure. Now let's examine them one by one. Purpose. This is very important because I might have a different purpose from my friend who is also looking to invest. My purpose of investment might be that I need high returns than FD, whereas my friend might be actually wanting to invest for short term, or maybe he's looking to save capital gains from certain sale of assets, and so that he doesn't have to pay tax, or maybe he's looking to get tax-free returns. So it's important to first start off with, what is my purpose of trying to invest into bonds? And let's say one of my purposes, I want to build a cash flow, frequent payment I should receive from my bond investments so that my overall earning in a month gets increased. So for that, I would definitely have to consider the other criteria, which is payment frequency. Does a bond pay monthly or quarterly or annually, right? And accordingly, I can take a judgment call. Next is amount. Bonds come across a wide range of ticket size. They start from as low as 100 rupees, which is for government securities and state issued securities called state development loans, to as high as 10 lakh to 1 crore. Now, so it becomes very important for me as an investor to understand what amount of corpus do I want to put into bond, because this is actually going to help me weed out a lot of the bonds from the list and come to a finite set from where I can pick and choose. It's an easy way to finally short down to a pack of bonds. Third, risk. Now, risk is basically the other side of the coin of returns. And as we all know, if I'm looking to take low risk, my returns will be low. If I'm willing to take a bit of a risk, my returns are also going to be high. So it's going to completely depend upon my persona as an investor. So what are the few things that we should look out over here? One is credit rating. It's not the full information like we discussed before, but yeah, it's a starting point to understand risk in the bond. Do I want to invest in sovereign securities? Do I want to invest in AAA, AA? That's one. Second, what category of bonds am I looking at? There are a few classifications over here with respect to risk from bonds, right? Secured versus unsecured bonds. And what does this mean? Secured bonds are actually backed by some kind of an asset. It can be physical asset, or it can be future cash flow from some separate project which is running in the company. Versus unsecured, wherein there is no backing up of that particular bond. When does this become important? In the worst case scenario, if the company fails, then secured bondholders are the ones who get money first, and unsecured bondholders, there is no promise to return them back in that worst case scenario. And as you can well understand, secured have higher safety, unsecured have lower safety. So secured bonds give lower returns, unsecured bonds are going to give you higher returns. Then the next category is senior bonds versus subordinate bonds. What does this mean? Once again, this clause also triggers in the worst case scenario, if an entity shuts down, then it is the senior bondholders who are paid first. And then if any amount is left, it's the subordinate bondholders who are paid. And last but not the least, a very important classification while evaluating risk of bonds that we should consider is the tier 1 and tier 2 bonds. These are specific category of bonds which are issued only by banks and some NBFCs, which is allowed by Reserve Bank of India. Now, they are highly risky bonds because in the ladder of riskiness, highest risky is equity, and just after that are tier 1 and tier 2. Now, why are they risky? It's because if the bank reaches a state of not being able to run its business, which is termed as point of non-viability or PONV, then Reserve Bank of India can actually step in and use its discretionary powers to write off the tier 1 and tier 2 bonds completely, and which means investors will lose their money. So as you can understand, given that they are so risky bonds, they would be giving very high rate of returns. And finally, T. T stands for tenure. Once again, bonds come with a wide range of outstanding maturity. They can be as low as 91 days, which is treasury bills issued by the central government, to as large as 20 to 30 years from corporate bonds or even from government securities. So it becomes essential for me as an investor to understand how long do I want to keep my money parked, right? Accordingly, I will have to take a choice and I'll get a set of bonds where I can put in my money. So just as a quick recap, part P stands for purpose. What is the reason behind I want to put in my money into bond? A stands for amount. How much money am I going to put into bonds? R stands for my risk and return that I'm looking for, that I'm comfortable with as an investor. And T stands for the tenure for which I want to make the investments. Now I'll take your attention to how to utilize this. Let me show you an example on Golden Pi quickly. So here the design of the platform is such that it enables investors to use this model very effectively. I'll show you with a quick example. Let's say I'm on the Golden Pi platform. I go to discover bonds. Now I start with the part model. Let's say I have got a very simple purpose of investment. I want my fixed income investments to yield me more than bank fixed deposits. So I select over here investment purpose. Number one, A, amount. I've got around 2 to 3 lakhs of money to invest, and this is what I would want to invest into. So I go down and I see the investment amount less than 10 lakhs. R, risk. So I start off with the credit rating over here. I say that, okay, I'm willing to take a bit of, the credit risk beyond beyond AAA. So I'll select, AA and probably A. And tenure. How long do I want this money to be parked? So I'm looking at a standard FD tenure because I'm using it as an alternate to FD. So I'm thinking of a period of around, say, 5 to 10 years. So I select this. So now on the platform, there were over 100 bonds that were listed, right, for investment. From that, by using this, set of 5 filter criteria, I've actually driven down that search set to just 3. Easy, right? That helps me tremendously to shortlist my bonds. Now I see that, okay, there's India Bulls, 2,72,000, 12.88%. Then there is MAS Financial, which is 9.89 lakhs. No, I don't want to invest that much. And then there's Muthoot FinCorp Limited, lowest in investment amount, 2 lakh, 10.75% yield. It pays monthly. Excellent. This will give me a regular cash flow as well. So if I click on this, I'm able to see the details of the instrument. It's at 2 lakh available. When I click this, I see it is available completely at face value of 2 lakh rupees, 2 units, and it gives monthly payment. When I come to the right hand side on the cash flow, I see that the payments are done every month on the last day, right, as the interest payments, which is great. This seems to be suiting my investment criteria. I can go ahead and make my investment here. So let us come back over here. With this, we come to the end of discussion from my side. Before I close, we will have one more poll, and after that, I'll take up the questions which have been raised by you, and I'll try to answer them one by one. So here is the question. Which bond paper do you think will be the safest to invest in based upon the discussion that we have made and the knowledge you would have already had? Will it be AAA rated bond of a large private sector bank, AA rated but tier 1 bond of a large public sector bank, or AAA rated bond of a large public sector unit, PSU? We have the answers now. So let me share the results. A resounding 72% have mentioned it's going to be AAA rated bond of a large public sector unit. And that is correct, because for the basic reason that government of India has got a finite amount of stake in public sector units, right? So there's an additional amount of safety which is built around them. Besides this, AAA rated bond, though credit rating of the highest order, it is from a public sector bank, right? It is from a private sector bank, my mistake. So there might be a risk, right? If the bank actually runs to a very extreme state, then there might be a chance that you might lose out on your money. It's a very extreme case, but it is possible. Second is double rated bond of a public sector bank. Of course, in public sector banks also, the government has got a percentage stake, but this is a tier 1 capital. And like we discussed, in the extreme scenario, it is possible that if the bank is not being able to run its operations, it's just going bankrupt, then RBI can use its discretionary powers to completely write off the tier 1 bonds. So that leaves us with AAA rated bonds of large public sector units as the safest bond papers to invest in. So with that, we'll close this, and now we'll move on to the Q&A session. So let's begin. We have got a long list of questions. I'm not sure how much we'll be able to accumulate during today's time itself, but let's attempt one by one. So the first question is, what is listed versus unlisted bonds? Can you explain, and what is the difference? Great question. So listed bonds are the ones which at the time of issuance, they get registered on Bombay Stock Exchange or National Stock Exchange or both, and they're traded, bought and sold over there. Unlisted bonds are the ones which are not registered on the Bombay Stock Exchange or the National Stock Exchange, or in short, on exchange. Now, another point to be considered over here is that listed bonds, the TDS over in listed bonds essentially is zero. There is no tax reduction which happens on the payments done via the coupons. For unlisted bonds, there's a flat tax reduction of 10%, which then the investor can actually claim while filing his taxes at the end of the year. This is the answer. Next is a question around define repo rate in layman words, in short. So in very simplistic terms, a repo rate is basically the rate of interest at which the central bank will lend funds to banks, the commercial banks, and in return, the commercial banks can then lend this money to borrowers across the country. So putting it in simple words, repo rate is essentially the rate of interest that the central bank is going to charge to the commercial banks for lending. And as of today's date, the repo rate stands at 4.9%. Let's move on to the next question. The next question is, this is from Mansi Choksi. So the question is, are SDL bonds risky as many state government loans are at all-time high? Excellent question and very pertinent one. See, it's difficult to say whether it is a state development loan, that is, a bond issued by state government, is risky or not. Why? Because, at the end of the day, State development loans are also categorized as sovereign grade bonds, just like the central government bonds. And there is, an internal structure wherein if a state government is actually in a difficult state, the central government can lend out its helping hand to help it wade out through its debt. There are provisions made over there. But ultimately, what would happen in reality, that's something that is very difficult to predict. But yeah, state development loans are at the same level, theoretically at the same level of sovereign safety as central government bonds. The next question is from Mr. Uday Bhanu, and the question is, the main drawback in investing in bonds is there is no scope of premature closure, that is lack of liquidity. Do you feel that the secondary market for bonds is robust enough to generate cash when needed urgently? Well, a very pertinent question. Yes, the liquidity in the bond market is on the lower side, right? So how do we actually address this? One is, investing in good quality bonds, because they are always bought and sold. The liquidity or the exchange of hands for them on higher rated bonds is much better than poorly rated bonds. That's number one. Number two, at Golden Pi, we have put in a structure wherein if somebody wants to liquidate bonds, we have got a protocol through which the bond sell request is broadcast across multiple financial institutions and bond houses, and through that, some amount of enhanced liquidity can be generated for the investors if they need the cash urgently. But then, will that happen in a single day or within a couple of days? There is no guarantee around that, right? It depends upon the situation or the bond that one is wanting to sell. The next question is from Nagabhushan, and his question is investing in Karnataka bond 1 crore, is it safe by buying it through Golden Pi 10.070 coupon rate? It's basically the call of the investor to judge the safety of a bond. On the Golden Pi platform, we provide all information, and if further is required, we can provide the audited financials and financial ratios of the company. But then at the end of the day, it has to be the call of the investor whether to deploy the money in the specific bond or not. The next question is from Dipali Tiwari, and she asks, can you please explain cash flow generated by bonds? Will it not be compounded with principal and interest, or will it be deposited in bank account? Good question. So if you're investing in a bond which is going to pay out coupon payments, it means that the interest will be actually paid in hard cash to your bank account. So let's say I invest in a bond, say I invest 2 lakh in a bond at 10% interest. It means annually I'll be getting 20,000 that will be credited to my bank account actually. Now I can go ahead and reinvest it into any other bond or any other security, or I can use it for my own consumption, right? So cash flow is basically the coupon payment that will be done by the bond till it matures. And this is the real cash or the real money as interest which will be hitting your bank account. But then there are another category of bonds which are termed as cumulative bonds or zero coupon bonds. Both these categories, they will essentially not pay you any interim interest as payouts, but rather at the end, you'll be getting a lump sum into your bank account. I hope this explains. The next question is from Sanyam Shah, and he asks the question, please talk about safety of bonds. Historically, how many bonds have defaulted? All right. So let me take up the second question first. How many bonds have defaulted? Well, in the AAA to A-rated category, since 2017, the couple of bond default that have happened are ILFS, there has been Yes Bank, DHFL, Altico, and Shrey Infrastructure. I think there was a default. So net, I think around 15 to 16 tranches of bonds have defaulted out of a pack of around 18 to 20,000 outstanding bonds in the market. So that's like the range of default that has happened. The next question is from Alvin, and he asks a question, I want to invest in bonds, But before that, want to understand the ratings, secured, unsecured bonds, and several other factors that are involved to assess them to make the right investment. Where to get the answer? Would be happy if you have any learning material. Well, you can visit Golden Pie. On the left hand side, there's a filter panel. All these are filters over there: secured, unsecured bonds, right? Senior bond, subordinate bond, tier one, tier two. The various parameters that you want to evaluate and shortlist, you can utilize over there. Apart from that, if you want to read up material, well, for any specific issuer or issuers, you can always look up the internet for those issuers on their annual corporate filings that they have. You would be able to see what kind of, revenue they have generated over the past couple of years, what kind of business they have been running, right? Look up CRISIL reports. CRISIL is one of the best credit rating companies, and they have got extensive research reports. You can look up over there and get a trove of information. And apart from this, for any individual who signs up on the Golden Pie platform and completes KYC, they are provided with a dedicated relationship manager. You can ask your questions, put forward your requirement for data, and the research and analysis team can provide that data to you via RMs. Now, this is next question is a pretty subjective one. So it's from Chetan, and he asks, buying bond 12%, is this a good option, or should I stick to 10% bonds only? Well, Chetan, this is completely at the individual discretion of the investor. It depends upon what kind of risk you're comfortable with, what kind of returns you're looking for, and then you have to take a call, right? At the end of the day, if I were in your position, I would definitely look at the background of the company first, and I would definitely look at the financials, the credit rating, and then take a call, right? So that I know I'm putting it in the right set of bonds. The next question is from Atanu, and he asks a question. Generally, the unit size of bonds is very high, 2 lakhs. Is there a way to invest in smaller amount, like SIP or like in mutual funds? Good question. Unfortunately, in bonds, there is no method of SIP like in mutual funds, but certainly you can invest at a much lower quantum of 10,000. So bond issuances come in from time to time via NCD IPO placement, where the minimum investment quantum is just 10,000 rupees, and you can invest over there, right, using UPI option. So it's a completely online journey. So the last NCD IPO that got closed a couple of days back was from Edelweiss Broking. It had a coupon payment. It had a yield of around 9.95%. Every month there is an NCD IPO or the other, right? Just look out for it. You will get your proper window to invest in lower amount. Next question is from Rahul, and he asks, after maturity of any bond, invested amount with return can automatically be credited to savings account? That's a question. Or maturity amount will credit on demat account. So here's the thing. Demat is for storing units of your investments, which can be equity, bonds, mutual funds. Demat cannot hold money. You can store your money only in bank accounts, right? And in case of bonds, the payment, interest payments, and also the maturity amount, that is going to get credited to your bank account, which is attached to your demat. The next question we have is from Anand Hariharan, and he asks, how safe the bonds are? Is it possible to break the bond before maturity, and how it will impact my cash flow? All right. So regarding safety, of course, bonds also have their own set of risks. One is a default risk, second is the interest rate risk, and third is reinvestment risk. Top 3 risks. There are a few others also. Now, if somebody invests in bonds which are issued by good companies with good cash flow, and very stable business, of course, it's definitely safe. It's definitely way safer than equity. Might be slightly riskier than bank FDs. Now, let's come to the next question, which is around liquidity. Yes, of course, bonds, do not come with any, lock-in period. They can be liquidated before maturity. And if you liquidate it, one, your cash flow, which is basically the coupon payments till the date you sell, right? Whatever are the coupon payments that you were to pay, you were to get, you will get it. They will get credit to your bank account. When you sell, it depends upon, what is the buy price you're getting. You might be selling it at a premium price also, or you might have to sell it at a discount price, depending upon the situation. So when you finally sell, based upon the price, whether it's at a premium, at a par, or a discount, your yield will also get modified accordingly. So if you sell at a premium, your yield will be way more than yield to maturity. However, if you're selling it at a par or at a discount, specifically, then your yield will reduce than if you would have held the bond till maturity. The next question is from P. Chilukuri, and the question is, can bonds be used as a collateral? I am not sure about the question, as in what form is it being asked as a collateral. If one is looking to use it for pledging for FNO options, yes, there are certain set of bonds from public sector unit companies which are marked by the exchange, and brokers, then they have their own set of bonds also which are earmarked as pledgeable. Divyadhar asks the next question, and that is, what would be the tax reduction on bonds? So there are two components to the taxation on bonds. One is the interest income that you get from it, right? That is taxed as per your income tax slab, be it listed bonds or unlisted bonds, right? Now, and this is something that you have to call out as your income, as income from other sources while filing for the tax returns at the end of the year. However, if you sell a bond before it matures at a premium value higher than at your buy price, then you're making a capital gains. Then for that, basically, if you're doing this activity within 12 months, you are liable to short-term capital gains taxation, which is as per your tax slab. If you're selling it beyond 12 months, you'll be subjected to 10% interest without indexation. For unlisted bonds, the STCG period is 36 months, and the taxation, for LTCG levels is at 20% without indexation. So that's how the taxation works. The next question is from Alagappan. What is a way out when a bond defaults? See, there's a very well-defined structure which has been set by a government uh, whenever there is a default that happens. So firstly, if an issuer is not able to pay the interest on time, after a certain period of time, it immediately is taken up by SEBI and other related authorities for examination as to why the payment had not happened. And finally, right, if the company is not running well, then NCLT actually takes up that entire issue and then investigates the issue to reach at a resolution, wherein what happens is the assets of the company in the extreme case can be sold off completely, money recovered from there and is paid back to the bondholders. But then the payment that happens to bondholders then has a certain pecking order, right? It's the senior bondholders who will be paid first and then subordinate. And similarly, it's the secured bondholders who are going to get the payment. There won't be anything for the unsecured bondholders in this worst case scenario. Okay. There are a lot of questions which are pretty much similar to what has already been answered. So, I'll try to take a couple of questions more and then we'll reach to the closure of today's webinar. However, all the questions, we will take them and, break them down into specific categories, and we will share the answers to all the our participants who have joined us today. We will share it over email. There is a feature request from Chandra Nataraja, and he says that if I have some bonds already, do I have any means or method where I can get automated message on bond downgrade or upgrade? There is no automated messaging procedure as such. We are putting up a similar feature which will intimate bondholders about any credit transaction that happens, and that's something that will come in shortly. But as of now, if there is any upgrade or downgrade, one needs to visit Golden Pi and see the change in the ratings. All right, next question is, this is around sell, and it is from Sunil Jain, and he asks, if I invest in bond and need money before its maturity, how many days it may take to sell and get money? Like I mentioned, liquidity in the bond market is on the lower side. Uh, it's always a best case effort that is put into, and typically for bonds which are getting bought and sold very frequently, um, it depends upon the time at which we are trying to sell it. So if it's a triple A rated bond, the liquidity is on the higher side, then double A rated, then A rated, and also the demand from investors. It depends upon a lot of those factors. So it can vary anywhere as soon as within 2 days, to it can be even a week or more. So it essentially depends upon what is the kind of bond that you're trying to sell. The next question is slightly on the technical side. It says, how do you? This is from Tushar Patil, and the question is, how do you calculate the returns when purchased from secondary market? Okay, the way in which the return calculation works over here is the XIRR. So you can use it in Excel also to find it out, that the purchase price in the secondary market, that is something as negative. You can mention in the Excel sheet that is like which is like cash outflow that's happening, and then you can mention the entire set of coupon payments if you're holding the bond till maturity, and then finally on the maturity date you get the face value back also of the bond, right? And then the dates on which these are happening, then you can use the XIRR formula and it will give you the effective returns that you're going to make on the bonds. In bond terms, this is termed as a yield to maturity. And other ways is, I mean, you can definitely refer up the internet, and you can see what are the standard yields of various bonds which are there in the market. Then in that case, you really don't have to do a calculation. There's a repeat question, a lot of repeat questions actually. I just answered what's the difference between listed and unlisted bonds, taxation on bonds, and what's the liquidation process, and risks around bonds, so on and so forth. So this is the last question that I'll be taking up for the day. And the question is, what is YTM versus coupon rate? And when we buy the bond, do we get the yield as mentioned, or there are changes associated? Okay. So YTM stands for yield to maturity. And this basically is the effective returns that you will make on investing in the bond. And what is the YTM dependent on? It depends upon the buy price in the secondary market when you're buying it, and if you're holding the bond till it matures. Coupon rate, on the other hand, is the fixed interest that the bond issuer is going to pay you on the face value of 1 unit of bond. So let's say I have got a bond of face value of 1 lakh, right? And the coupon rate is 10%, right? Then that means every year till maturity, this bond is going to pay me 10,000. That is my coupon rate. But let's say I bought this bond in the secondary market at 1 lakh 1,000. Then because I'm buying it at a premium, my YTM is going to be lower than 10%. Now let's come to the second question. When we buy bond, do we get the yield as mentioned, or there are changes associated? When you're buying the bond from the secondary market, you have to consider the final settlement amount, which is the principal amount plus accrued interest as of the day when you are paying the money. Based upon this and the cash flow till maturity, will your yield get calculated. And yeah, if you hold the bond till maturity, your yield is going to remain fixed. It's not going to change. So there are a lot more other questions actually, but we have run out of time. It's been wonderful interacting with all of you. And I hope I have been able to share something, something important, something that you can take away from this session. And there would be a quick question just at the end of this, wherein please do share your opinion about what is that we can do better, whether you like this this webinar, and this will actually help us in improving. So until next time, thank you everybody. Bye bye.